Okay, good morning. We are doing Chapter 9 today, and we do have a Learning Catalytics question out there right now. It'll be open for a little while, so do get logged into that. Samantha, you can, by the way, someone asked me a question. You guys might like to know this too. For managerial accounting in the spring, if you're scheduling with Rose, he has one online section with no meeting times. That's a traditional online class. But his other classes are all just in person, and he does collaborate as well. So you can attend. So even if it's a face-to-face section that you see with Rose online, you can attend from home the same way. So you can do that with him. The only way you can use ProctorU with him is to get in that other section, that little section he has. But anyway, so I think that answers your question, Samantha. Okay, so anyways, he does managerial accounting with Rose, does use Collaborate as well. Okay, so the question that's on Learning Catalytics right now is this chapter is about liabilities. So the question to start off the chapter, because we've talked about liabilities before, is which of the accounts below is usually not a liability? It's probably ever a liability. Interest payable, unearned revenue, taxes payable, investment in bonds. So in Learning Catalytics, you have to choose your answer. And again, we're going to leave this question be open for a few minutes. So if you haven't answered yet, you have time. But the answer will be investment in bonds. That's an asset. So again, that Learning Catalytics question is open. It's going to stay open for a few minutes for people coming in late. I'll go on the screen and just try something right now. I'm going to make it bigger in the future. But the session ID will be in the lower left-hand corner. Haley, of course, is typing it into the chat room if you're online. Okay, so a couple administrative announcements before we get going. If you want to see exam 2, if you want to review it, Haley has hours this week, Tuesday, tomorrow from 4 to 6 p.m., Thursday from 11 a.m. to 2 p.m. She's in room 579 in the College of Business. So you take the elevator up, and if you've not been on the 5th floor before, it's like a figure 8. So eventually you wind your way around. And so she'll be in 579, and you can just show up and she'll go over your exam with you. So that is this week. Those are the same times and locations that I emailed out a couple days ago. So that's there. By the way, on Wednesday I'll have the exam average. It's somewhere in the 70s. I just don't remember it off the top of my head. And then I'll have the list of scores as well, so you can see where you fell. And we had a lot of nice scores there up at the top. And then I will also tell you that the final exam tends to be easier for most people. You're through the worst of it. But that doesn't mean you don't have to study. You still have to study, but the third exam tends to be a little easier. Our final exam is not comprehensive. So it's over chapters 9 through 13. There are several learning objectives we will not cover. So when we get to the beginning of each chapter that we're covering, I'll tell you if there's learning objectives we're not covering. We're going to go through parts of chapters, particularly in my mind I'm thinking 10, 11, 12. We have parts of them that we do not cover. So it's a very manageable list of chapters. The final exam, and I'll talk more about this in the future, but in case if you're one of those future planners, the final exam will be available Sunday through Tuesday of finals week. So you have to take the final exam Sunday, Monday, or Tuesday. It's due Tuesday early evening. And if you take it Sunday, there will be an early exam bonus offered as well on that one. So plan your schedule accordingly. Typically, I don't know the proctor hours on Sunday for sure, but typically 9 a.m. to 6 p.m. And Haley and I are the proctors on Sunday. There's a few more. So Haley and I are proctoring, and because we are proctoring that day, we do get exclusive use of the lab from 9 a.m. to noon. And so in the past we've had Actually, I think last year we had 250 people come through on Sunday, which was a lot, but we were able to move people through. There's 2 of us. There's a couple other proctors. And because it's just our class, that 9 to noon tends to have a lot of openings. And then it does, we have a fair amount of opening. It's pretty steady all day actually. You weren't, what am I looking at? You didn't proctor last year. It was Brian. Okay, but it was pretty steady throughout the day Sunday. So, and I believe it ends at 6 p.m. on Sunday. So regardless of how you take it, you have to have it submitted by 6 p.m. on Sunday. So if you're a ProctorU person, you may want to take a look at that. And as I'm telling you this, I don't know if I've told them the Sunday yet, but I'm pretty sure I have. But I'll verify that after class. So just for your planning purposes, if you want that early exam bonus and you'd want to get this one out of the way, Sunday's a good day to do it. So we will be offering the exam on Sunday and then Monday and Tuesday as well. Yes? I don't know the exact date. It is the Sunday before finals week. Yeah. Did somebody say it? The 7th? 7th. She's looking at our calendar. Okay. Okay. So. Oh, good. Thank you, Leah. Sunday is listed in ProctorU. So the thing to remember is you have to submit your exam by 6 p.m. Eastern Time, not start it by 6, because I think the Proctor Lab closes at 6 as well. So you're going to have to start the exam by 4 p.m., or earlier. But make sure, so anyways, get your appointments lined up. By the way, again, if you're scheduling with ProctorU, call them. If there's any question at all, don't hesitate to pick up the phone and call them. They are famous for voicemails, but call them, leave a message, they will get back to you. And if you need to, you can contact me if you don't seem to be getting anywhere, but give them a chance to call you back. But okay, so that's review your exam. This week, Saturday, we have Chapter 9 homework due. Section 3 has a regular quiz. That's not most of you, just Chapter 9 homework. And again, the Learning Catalytics question is still open. So anybody coming in late can answer. Okay, so now any questions before we get really going in Chapter 9? Okay, today is going to be a lot of talking, and we'll do more of the homework on Wednesday. Today is just kind of talking about liabilities and a fair number of Learning Catalytics questions, and the first one's still open. Okay, so liabilities. We're talking in this chapter about liabilities. Current liabilities, long-term liabilities. Liabilities are debt. So when we start here, I'm going to start, and this, whenever I talk about target, you do not need to know this for the exam, but this is to put this in perspective. First of all, this is Target's 10K for 2013. Their 2014 one's not out yet. But this is their 10K. A 10K, for those of you that don't know, is their annual report as they submit it to the SEC. Many companies combine their annual report with their 10K. Their 10K is their annual report, or the annual report is their 10K. The 10K is governed by lots and lots of regulations. So a 10K is what they publicly submit to the SEC. You can get 10Ks for any publicly held company. It is an annual. The 10K is issued once a year, and it contains all their financial statements. It contains a lot of information. 10Ks, if I had to guess, the average 10K is probably 100 pages, 125 pages. But it's going to include all 4 financial statements. Okay. It's going to include all 4 financial statements that we've talked about. It's going to include the income statement, the statement of retained earnings or stockholders' equity. It's going to contain the balance sheet and the statement of cash flows. What we're looking at here is Target's balance sheet. And it says at the top of it, it's its consolidated statement of financial position. That's just another name for the balance sheet. It starts with assets and goes to liabilities and equity. Now, right there, that middle section, liabilities, I've circled it because now I'm going to make it bigger, and you'll see if I blow it up, we've got a list of liabilities, and then on the right-hand side, we have the 2014 number, and then we have the 2013 number. Companies are required to show at least 2 years. Depending on the statement, they might have to show up to 5 years of data. So what I'm doing now is I'm taking that list that was right there in the really small print, and I just blew it up and make it bigger. So we got rid of the numbers. So what we're talking about in this chapter is we're talking about a whole bunch of different liabilities. Now companies can call them different things. They don't all call them exactly the same things, but there's some commonalities. The first one above what I circled is accounts payable. Accounts payable is when a company buys inventory or buys supplies from Staples and says, we'll pay you later. That's accounts payable. That's going to be the top of the current liabilities. It's due within a year. And then we work our way down to other liabilities. Now, when a company issues its financial statement, so it issues the financial statements either in an annual report or a 10-K, it doesn't just issue 4 financial statements. Financial statements mean nothing without the notes to the financial statement. The notes to the financial statement provide more information about each of these items. It helps the investor understand. The notes to financial statements are very, very precisely worded. There's a lot of wordsmithing that goes on. You have the accounting people doing it. Then you have the legal team looking at it. The notes are integral to the financial statements. So what we see here is a list of Target's liabilities. So this is the liability section out of their balance sheet. The first one, accounts payable, there's not a note about that. But this other one, accrued and other current liabilities, if we look at the note for that, we will see accrued and other liabilities. So again, we're in Target's 2013 10-K. We see they have wages and benefits, real estate and other taxes payable, gift card liability, dividends payable, so a whole slew of payables. So that tells the investor what items that Target's going to have to pay in the next year. These are current liabilities. Again, this is nothing you need to memorize. These names will vary according to the company and what their business is, but these are all things that they have to pay coming up in the next 12 months. Okay, the next one down is current portion of long-term debt, and then I've also circled long-term debt. Target has long-term debt. These are bonds that they've issued. And they've issued the bonds and people have given them cash and that they've borrowed money. Also, they could have mortgages where they've taken out a mortgage on a property and are going to make payments over time. Now, this long-term debt is due in more than a year. So that's where it sits on their balance sheet as long-term debt. But when they go to prepare the financial statement, they take the portion, the principal that they have to pay in the next 12 months and stick it in current liabilities. Because when an investor picks up a balance sheet, the investor wants to know how much Target has to pay in the next 12 months. So we're taking the current portion of long-term debt and throwing it in current liabilities. So every company is going to split their liabilities between current liabilities and long-term liabilities because it really is helpful to see how much they need to cover now. Next one's down, we have, and this is the notes payable long-term debt. It's telling you when it's due, so the investor sees all these long-term due, what's due. Also shows us some more information about required principal payments, commercial paper transactions. So it's providing a lot of information to the investor about the details of that long-term liability. Okay, the next two items down, deferred income taxes, other current liabilities. Again, we go into the notes and we see that this is deferred compensation, workman's comp, pensions, post-retirement health care. Those are all long-term liabilities, and Target's telling the investor how much of each of these they have. This is a big deal to investors. These notes are hugely important. So I just want to kind of show that those exist. So when investors look at the financial statements, they're not just looking at numbers. Numbers, we have a hard time interpreting numbers all by themselves, but instead we have notes that disclose information about them. So we're going to come back to Target towards the end of class with what situation they find themselves in. But for right now, we're going to start kind of at the top of the balance sheet, top of liabilities, and work our way through. Today I'm going to give you some very basic journal entries. We're going to talk about how to treat, basically today we're doing mostly current liabilities. So we're going to walk through current liabilities today, the terminology, the journal entries we need. So current liabilities are these obligations due within a year. We always see that within the operating cycle it's longer than a year. That won't affect you in this class, this operating cycle that's different from a year. That will affect you perhaps if you're an accounting major, but for our purposes, current liabilities are due within a year. Okay, there are two kinds of current liabilities. There's ones with known amounts and estimated amounts. Okay, so known amounts mean that we know those amounts with pretty much certainty, or we can estimate them very closely. Well, we have estimated. Okay, known amounts, we know the amounts or we can calculate them. Okay, like interest on a note. So first we're going to start with known amounts. Okay, so current liabilities of known amounts. We have several possibilities. We have accounts payable. That's usually the first one. That's a major one for most companies. This is where they're buying merchandise for resale. They're paying their suppliers. They're buying raw materials to use in their processes. But these are vendors they're buying from. So this is accounts payable. By the way, a lot of what we do in the liabilities chapter is going to mirror what we did in an earlier chapter. Because if we have, for example, an account payable, that is the mirror image of the vendor's accounts receivable. So the calculations will be similar. So we have accounts payable. Accounts payable, we buy stuff from vendors. Then we have short-term notes payable. We're going to talk about each one of these. Yes, we are going to talk about every one of these. Sales tax payable, accrued liabilities, payroll liabilities, unearned revenue, and current portion of long-term debt. So that's kind of our guidepost for today, what we're doing. We're going to talk about each one of those, and then when we come back on Wednesday, we're going to do the long-term side of things, and then a bunch of homework problems. Again, we're going to do each one of these. So starting with accounts payable, I don't have a separate slide for accounts payable for today, but accounts payable are the amounts we owe our vendors. So if we go and we purchase something on account, we're going to debit, say, inventory and credit accounts payable. That's all that is. And we've done those journal entries before, but accounts payable is simply we're buying from a vendor. We're buying something. We're buying a service. We're buying an asset. We're buying something. Next one down, short-term notes payable. We will talk in more depth about this. This is the mirror image, for the most part, of notes receivable. So what we've got with our short-term note payable. These are notes that are due within a year. It's used to borrow cash or purchase an asset, and we have to do an accrual for the interest on this. So short-term notes payable, this is when I worked at Plastic Lumber, we occasionally would buy new tow motors or forklifts. And the vendor that we would buy these from would sell us the forklift in exchange for a one-year note. So we'd sign the note, so we'd get the forklift in, so we'd have a new asset, and then we'd have this liability to pay them in a year. And the big difference between a note payable and account payable is notes payable you have to pay interest on them. Accounts payable, typically no interest. There's no terms. You just pay your bill within 30 days or something like that for accounts payable. But notes payable is a formal promissory note and it carries interest expense with it. But this is a common way to purchase services or goods if you're going to be making payments over time. With short-term note payable here, then I've got a series of 3 journal entries. There's 3 journal entries we need. I would star them because they're going to look the same every time we do them. Just the numbers will change. So let's say we've got this example. So short-term note payable, following entries cover the purchase of inventory costing $8,000. So we're purchasing inventory for $8,000. We're going to accrue interest expense and we're going to pay off the note at the end of the year. So that's our illustration. So those facts are all given to us. So the first thing we're going to do is we purchase inventory on January 1st by issuing a note. Okay, so the dates just given to us, we purchase this inventory, issue a note for $8,000. So what we're going to see when that happens, what's happening if we purchase inventory is we're getting an asset. Assets are increasing. We've got inventory now. But in return, we have a debt that we didn't have before. We have a long-term debt, so our liabilities are also increasing. So what we're going to have is we're going to debit inventory. Our asset is going up. Okay? So we've increased assets. And then on the other side of this, we are increasing our liabilities by crediting short-term notes payable for the $8,000. So this transaction, when we purchase something with a note payable, we're increasing assets, increasing liabilities. Okay, so just a reminder, there's still that original first question out there. It's going to be closed within the next minute or so, so make sure you answer it. And we went over that question in the beginning, so if you answered it in the beginning, you're good. Okay, the following, so we have the purchase inventory by issuing a note. Next up, what we're doing for the next journal entry is the company's fiscal year ends September 30th. So this note was dated January 1st. So we go through the 9 months, the remaining 9 months of their year. Their year ends on September 30th. On September 30th, they have incurred 9 months of interest on this note. Even though they're not going to pay the interest until the 1 year, they have a legal obligation on September 30th that they have incurred interest for 9 months. So we need to accrue the interest. These accrual entries are like the entries we did in Chapter 3. So we're going to accrue the interest. Now, it's an $8,000 note at 10%. That's for a full year. This is only 9 months. So we're going to have the $8,000 note times 10% times 9 months out of 12 because we've only held the note for 9 months at the financial statement date. So we're accruing $600 of interest as interest expense. We want to recognize that during this fiscal year, we had this note outstanding and we owe the $600, okay? And then the other side of this is going to be interest payable. Interest payable is $600 because that's how much we've accrued. So as of September 30th, we're not paying the interest then. We'll pay it on January 1st when our year is up. But September 30th, we need to show investors that we have an obligation to pay the $600 and that we've incurred interest expense of $600. Next up, now January 1st, 2015 comes along. We have to pay the note. So we're going to pay the note, and when we pay the note, this is actually going to take several lines. Okay? So we have to pay the note. First thing, when we pay the note, this note was $8,000. We recorded a liability for $8,000. First thing we want to do is get rid of that liability. So we're going to debit note payable for $8,000. So we're going to see that right off the bat, debiting $8,000. That's getting rid of the liability. That was when we originally, the face value of the note. Okay, now we don't have the original. Do you have a question? We don't have the original liability either, but the other thing that we don't have is the interest payable. So we want to wipe out that accrual that we just did. The liability where we said we owed $600, we don't owe it anymore because we're paying it off. So right now what we've done so far is we've wiped out the original liability, we've wiped out the accrual liability. And now our next line down, we need to recognize interest expense on this note for this financial period. We've already recognized 9 months of interest expense for when we did the accrual. That was through September. Now this is January 1, so we have October, November, and December. We have 3 months of interest expense to recognize. So we're going to take the $8,000 times 10% times 3/12. And that will give us $200 as our interest expense for this period. So what we see we're doing here is we're getting rid of the original face value of the note, we're getting rid of the accrued liability, and we're recognizing interest expense for the portion since the last financial statement. Now, to get how much cash we're paying out, we can do it one of 2 ways. The easiest way, I think, we're going to have a credit here to cash because we're paying the note off with cash. And the easiest thing to do is add up those numbers we've already put. Our debits have to equal our credits. So our cash is going to be $8,800. That's the $8,000 plus the $600 plus the $200. Another way to do it is to say, well, our note's due at maturity, and it's $8,000 times 10%, so $800 of interest on top of the $8,000, so that's $8,800. Either way, we get the same amount. So it's going to be the $8,000 plus the interest on the $8,000, the full amount, that's $8,800. Our debits equal our credits, and that's what we do when we pay this off at maturity. So those are the 3 main journal entries when we have a note payable transaction. Those are good to know, and the only thing that's going to change from transaction to transaction are the numbers. Those are the real basic ones. You might not have an accrual on it if it's not between financial statement dates, but other than that, it'll be the same. So accounts payable, notes payable. Next one we're going to look at is sales tax payable. I just read an article a week or 2 ago. The state of Ohio was closing 400 businesses across the state of Ohio because they hadn't paid their sales tax to the state. Sales tax is very serious. Unless you're a very, very small organization, you have to remit your sales tax collected every month, and it's now done electronically. Okay, so sales tax is levied on retail sales. So we make a retail sale, it's collected from our customers and remitted to the state. Now the important thing to note is sales tax is not considered revenue. It's considered a liability when we collect it. So let's say on a given day, sales at Home Depot were $200,000, all in cash. We're just going to keep it simple. So there were $200,000 of cash sales. Home Depot collected 5% sales tax. So 5% of the $200,000 is $10,000. So in total, Home Depot collected $210,000 of cash that day. So here's what's going to happen in terms of a journal entry and the impact on the financial statements. First of all, we know Home Depot got cash, and their cash amount is the $210,000, right? Because they're collecting 5% sales tax on top of the revenue. So they sold $200,000 worth of stuff. They have 5% sales tax. So $210,000 is what was in Home Depot's cash registers that day. So they have this asset. Okay, so they pumped up their assets. They have this cash. Now on the other side of this, we have sales revenue. The sales revenue is going to be the $200,000 that that's the $200,000 represents the selling price of every item that went through the register. So the tag that was on the item, that's the sales revenue. And then we'll have a credit for sales tax payable. That was the 5% sales tax on top of that. So you know when you go buy something for $10, it actually costs you something like $10.70. The store records $10 of revenue, and then they record 70 cents of a liability. So the sales revenue is the, just given the 5%. The sales revenue is the amount of the sale. The other part, the sales tax. In any problems we do in here, you'll be given the sales tax rate. So a lot of times we use 5% because it's a nice round number. But that's what's happening. So when a store makes a sale to you, they are recording revenue for the amount of the selling price, and then they have a liability for the amount of sales tax. And then they have to pay the sales tax every month. Okay, so that's sales tax payable. So you set up that liability, and then when you pay the sales tax to the state, you're going to debit the liability and credit cash because you're spending cash. So that's sales tax payable. You collect the money, you remit it. It's pretty fast. You collect it, remit it, collect it, remit it. So, and you get in lots of trouble if you do not remit it. Okay, next up, accrued liabilities. So these are liabilities that have been incurred, but we have not yet paid them. So this would be, I get my electric bill, I'm not going to pay it for 2 weeks, I still have to accrue it. I've used the electric. So categories of this would be salaries and wages payable, interest payable, we just saw an example of interest payable, income taxes payable. So what we're going to do next is we're going to actually look at payroll liabilities. So this category of sales and wages payable, it can take many different forms. It's also called employee compensation. So we have employee compensation. It's a major expense, if not the major expense of many companies. It can take the form of salaries, wages, bonus, commission. Those all stand for the same thing. The complicating factor for companies is that they have to withhold taxes because you know if you make $100, you're only going to see 80 of that or 70 of that, and the rest is going to be withholding. Your employer doesn't keep that money, they remit it to the government agencies. Okay. So let's look at these payroll liabilities. Okay, so let's just say Exhibit 9.1 in your text. This example is in Exhibit 9.1. I'm totally making up the number. The book just made up the numbers. These numbers are not calculated. So let's say the payroll for a given period is $10,000. Now payroll might end on Friday. We might not pay it for a week. Typically, you do not pay payroll the day it ends. You need about a week to do the calculations and get everything all set up and get ready to remit it. So the payroll ends, and let's say you have $10,000 of salary expense. So that's the salaries of everyone you're paying through this payroll period. So salaries expense, that's great. Next up, you know that when you pay employees, you have to withhold federal tax. So we have employee income tax payable. Sometimes it's called federal tax payable, but it's some income tax we're withholding. So those numbers, we have tables, there's calculations for how that's done based on how many exemptions, etc. This also is state withholding, it could be city withholding as well, but the amount of the withholding goes into a liability. When an employer has payroll, they have payroll expense for the full salary, and then they're going to have a liability for the withholding. So all the withholding they do on all their employees' behalf goes in a liability account. And then FICA. If your employer pays FICA, FICA goes into another liability account. So all those withholdings, so everything on your paycheck that you don't get, that's all a liability for your employer. And there's strict rules about when that has to be remitted and when they have to pay and do their reporting. And then finally then, the difference in the salaries payable is your net pay, is basically what it's coming down to. So the full salary less all the withholdings gives you the salaries payable. So that's what the cash will be for when we actually do the payroll, pay the payroll. There's not set categories for those. And the PowerPoint slides are on Blackboard, but you can answer whatever you want. But the question was, what are the categories for accrued liabilities? There's not set categories. You don't have to memorize the set categories. You just can, there are things that we accrue. And again, the slides are on Blackboard, but you can finish that. I just want to interject there. Okay, now another big category, and we've seen this account before, and you want to make sure that you understand that unearned revenues is a liability. Unearned revenue, going back to the many weeks ago where we had the mower guy collected $600 in May for mowing to be done over the summer, that $600 was unearned revenue for the mower guy. It's a liability. These are called deferred revenues, revenues collected in advance, and this is when the business receives cash before earning the revenue. So when the business gets the cash, they still have to perform a service or provide a good. This is a liability. Even though it says unearned revenue, it is a liability. When you buy a gift card from Target, so you go buy a $50 gift card from Target, that $50, you give Target $50 so they get cash. They also have an instant liability. That is not revenue to them. When you take that gift card, they have a liability until you use it. When you use it, they're out of their liability and they can recognize revenue. Similarly, if you buy a concert ticket, you pay for that concert ticket. The person, the company that's putting on the concert has a liability until that concert is performed. So they do not have revenue for ticket sales. So you might have lots and lots of ticket sales, but you're not going to recognize the revenue until you perform the concert. Similarly with Cavs game tickets, they have record ticket sales. Doesn't mean it's hitting the income statement yet. It's going to hit the income statement as they play those games. Okay, now let's say Southwest Airlines. So this is another example of unearned revenue, and this is a good example of another name for it. On December 15th, Southwest Airlines collects $300 for a round-trip ticket from Dallas to LA. Okay, so $300 they sell on December 15th. On December 28th, the customer flies to LA, so does the first leg of it. So first of all, December 15th, when Southwest sells that ticket, they get cash. Okay, so that's the easy part. They get cash. They do not have ticket revenue though, because they have not flown. They have not provided the flight yet. So until they provide the flight, they put it in an unearned revenue account. Now a lot of companies call it unearned revenue. Southwest does not. Southwest comes up with their own name, which is fine, and they refer to it in their notes as unearned revenue. They have something called air traffic liability, which is simply their unearned revenue for flights that they have to deliver still. So when Southwest sells a ticket, they're increasing their assets and they're increasing their liabilities. Revenue is not recognized when they sell that ticket. Okay, so now the customer comes on December 28th and flies to LA. So the customer, it is a round trip ticket, so the customer has used up 1/2 of that ticket. So on December 28th, Southwest can recognize 1/2 of the revenue. So on December 28th, Southwest will reduce its liability for the 150, half of the revenue, and it will recognize ticket revenue for the 150. So again, the customer, it's a round trip ticket, so the customer has used 1/2 of that so they can recognize. And when the customer flies back from LA to Dallas, Southwest can recognize the revenue for the other half at that point. So you don't recognize revenue until you actually perform the service or provide the goods. Until that time, it's unearned revenue and it's a liability. So next up is that category called current portion of long-term debt. Current portion of long-term debt current portion of long-term debt is also can be named as a couple different things. We can talk about current maturity or current installment. Installment just simply means they're making monthly, quarterly, semi-annual payments. They're making some kind of payment. And this is the amount of principal payable within 1 year. And I do want to emphasize that this is the amount of principal they're going to pay over the next year, not the 12 months of payment, because that includes interest. We're talking about what principal payments do we need to make within the next year. So what companies do is they have long-term debt. So these are the bonds, these are the mortgages. They're all sitting on their balance sheet in long-term debt. So it comes financial statement date, we have to calculate how much of that we're going to be paying in the next 12 months. And that amount, that principal amount, we have to take it out of long-term debt and put it in current portion of long-term debt, because our investors are very, very interested in whether we can pay our current obligations or not. So we show them this current liability the current liability amount, and they can compare that to our resources, and do we have enough resources to cover what's coming due. So it's the amount of principal payable within the year. Okay, so up to this point we've done these that are all known amounts. We might not know them, but we can calculate them. We can calculate the interest payable. We can calculate our salaries, our payroll obligations. Now we get into ones that we have to estimate. And estimated liabilities are going to fall in these current liabilities. We have estimated warranty payable, and we have contingent liabilities. So estimated warranty payable. We sell products. They come with a guarantee. We basically, bottom line, we need to recognize an estimate of our warranty expenses when we make the sale. So we have to record warranty expense in the period in which we make the sale. We don't know how many are going to require warranty repair or replacement, so we have to estimate this. So this is an estimated current liability warranty, and we're going to go through a journal entry. And while we're here, we're going to fill out the contingent liability column, because we're going to come back to that too. Contingent liability. Potential liability depends on future outcome of past events. That definition, very good to know. Okay? Potential liability that depends on future outcome of past events. The accounting for a contingent liability. This is something that hasn't happened yet. That trigger hasn't happened yet, but it might. There's three choices. We can accrue, we can disclose, or we can do nothing. And we're going to come back to that. On our next slide, we're going to talk about warranties payable, and then we'll do contingent liabilities. I would say concert's the same. If you miss a concert, you're out of luck. The event passes, you can recognize revenue. Yeah. Okay, so our accounting treatment for contingent liabilities, 3 choices: accrue, disclose, neither. We'll get to that. But for right now, we're gonna zero in on the warranty estimate. So let's go through Black & Decker. Okay, they manufacture a lot of small tools. They will have warranty. They have a guarantee that warranties their small tools for a year or however long their warranty is. Now let's assume, and we're making these numbers up, they made sales of 100,000. Okay, and these products, the 100,000 was products that had warranties on them. Assume that in past years between 2 and 4% of products proved defective, and Black & Decker estimates that 3% of sales will require repair or replacement. So these numbers are all given to us. So a company's going to look at its past warranty experience and come up with some rule of thumb or some estimate of how much of its products need to be repaired or replaced. Hopefully it's not a lot, but if you sell enough products, you're going to have some kind of warranty expense. So you have to record that when you make the sale. So Black & Decker makes this sale, but they also need to recognize warranty expense. So they said that it would be 3%. So we're going to take the 100,000 sale times 3% and call that warranty expense. And then we're going to credit this account called estimated warranty payable. So this is where we hold our estimate of what our warranty expenses are going to be, what our warranty liability is. So this journal entry is made within the period in which we make the sale. We want to match the warranty expense to the sale, even though we don't know how many are going to go bad. If we knew they were going to go bad, again, we wouldn't sell them. We'd sell good units. So we have to make some estimate. So in this case, Black & Decker is estimating that out of the sales this period, $3,000 will be subject, $3,000 of warranty expense will be incurred. Okay, so that's journal entry 1. That's done in the period of sale. Now the second scenario, now let's assume now that the defects add up to 2,800. So this is now a future period. So people have brought in their small tools and we have $2,800 of replacements. So what we need to do then is we're going to take that $2,800 out of the liability. We say, oh look, we accrued for this. So we're going to take $2,800 and debit the liability, and then we're going to credit inventory for the $2,800 because we're replacing these things. We could also have some other credits, but this is a good enough one to know for here. So we're going to debit the liability. So when we actually incur the warranty expense, we're debiting the liability, crediting inventory. And then the T account for that liability, the estimated warranty liability, is down in the box in the lower left-hand corner. We started with $3,000, which was our estimate when we set up the liability. We've now charged it $2,800 for these actual, so it has a balance of $200 going forward. And there could be more warranty expense in the future, so that's lingering out there. So warranty expense has to be recognized and estimated in the period of the sale. Okay, now we have a Learning Catalytics question. Okay, Learning Catalytics. All of the following are current liabilities except what? Accounts payable, inventory, short-term notes payable, or wages payable. So all of the following are current liabilities except what? Accounts payable, inventory, short-term notes payable, or wages payable. Okay, you have about 10 seconds to submit your answer. Okay, and the one item that's not a current liability is inventory. Inventory is an asset. Everything else there is a short-term liability. Okay, next up, we're back at contingent liabilities. So contingent liabilities, there's probability associated with this. So if this event, because a contingent liability is based on some trigger, some future event that's based on a past event, some future outcome to a past event. So our probability can be probable this happens. If the probability of whatever happening is probable and we can estimate it, we are going to have, we're going to accrue it and disclose it. When we talk about disclosing it, that means in the notes to the financial statements. There's a note for contingent liabilities. So we're going to talk about it in the notes, and we're going to accrue it. When we say accrue it, it hits the income statement. It hits the balance sheet. We see a liability. We see an expense. So when we see accrue, it hits the financial statements, disclose. We always have to disclose if it's on the financial statement. Next one down, if the trigger is the event is reasonably possible it'll occur, we disclose. So we don't put it on the financial statements, but we still talk about it in the notes to the financial statement that this might happen. And then finally, remote. If the chance of this happening is remote, then we don't do anything. And an example of a remote thing would be a frivolous lawsuit. Someone's suing you for a completely ridiculous thing. We don't have to disclose it either. So what we're going to do now is we're going to talk about contingent liabilities for Target, because Target had a very interesting event. Interesting is one word for it. So how many of you in the last year have gotten new credit cards issued to you? Replacements, right? Yeah, I just got my third one. I was part of the Home Depot now. So I started with Target and then got it replaced, and now I'm on my third replacement. And that's expensive for companies to keep reissuing credit cards. So let's talk about Target. So Target had a data breach. It was the first of the really big ones, but we've seen big ones happen since then. But this happened in the fourth quarter of 2013. So what happened was hackers broke into Target's point of sale terminals and captured credit card information as people bought things. So then this happened in the fourth quarter of 2013. So then when you look at the 10K for Target for 2013, you see a note for contingent liabilities, and they talk about the data breach. This is a big deal to them. This is a big deal to a lot of people. So what we're going to do is, this is just, you do not need to memorize this. This is just looking at contingent liabilities. So in those notes to the financial statements, Target says, there's excerpts here I put. In the fourth quarter of 2013, we recorded $61 million of pre-tax data breach related expenses, et cetera, et cetera. Then it also includes an accrual for estimated probable loss related to the expected payment Cars Network claims. And then it talks about some other things. So it's talking all about their data breach. And then it finally ends up talking about possible penalties from the Federal Trade Commission, from the SEC, from the State Attorney General. A lot of the states are suing Target for the data breach. So Target has a long list of litigation that's facing, that's starting to work its way through the court. So they have all these contingent liabilities. These contingent liabilities are based on a past event, which is the data breach. The outcome is how the lawsuits turn out, whether they get the fine, etc. So this, remember, is their financial statement at the end of 2013. Now the rules for this, and again we've already talked about this, but we accrue if the loss is probable and we can estimate the amount. If we can't estimate an amount, we can't accrue it, simply. If we have no idea, we can't accrue it. But if the loss is probable and we can estimate it, we're going to accrue. We disclose if it's reasonably possible, which is something less than probable but more than remote. And then if the chance it's unlikely to occur, then we don't report it or disclose it. So what we're going to do right now is Target listed 3 potential liabilities. The first one is a liability to the credit card companies for the expenses associated with credit card reissuance. So this is Visa and MasterCard, the cost of reissuing 70 million cards. If you think about that, that's a mammoth amount of reissue. You look at the postage paid on each of those when they mail each card out. So they have to mail them out, and that costs them anywhere from 50 cents to $1, depending on how many cards are in there. And then you have to call in and say it's me and verify that you received it. So that takes money. They've got to pay for the cards. So there's all kinds of expenses associated with that. Visa and MasterCard are not footing that bill. That's Target's problem. So we've pushed a question out, or we are pushing a question. Did you already push it out? Okay. There's a question out on Learning Catalytics. So the cost of reissuing those credit cards, is Target going to accrue for that, disclose it, or do nothing? This is as of the end of 2013. Does Target accrue, disclose, or do nothing are your choices for reissuing the credit card to the expense of giving everyone new cards. Okay. Get your vote in. We're going to close this fairly soon. So these are the costs of reissuing the credit cards. The cost of the new credit cards, the cost of mailing it, the cost of verifying that you got it, etc. Okay, 10 more seconds on this, so get your answer in. So again, we're looking at whether we accrue, disclose, or do nothing. This one we're going to accrue because they know that this is probable. You have a data breach for 70 million cards. You're going to have to replace those cards. And you can reasonably estimate. We could weigh an envelope. We know how much it costs to mail it. We know how much it costs to make them. They can reasonably estimate that. So they had to accrue for the cost of replacing those 70 million cards, even though they weren't paying it until 2014. Okay, so the next scenario, so that was probable and the amount reasonably estimatable. Okay, so the next scenario is the liability to the credit card company for the losses resulting from the fraudulent use of the stolen credit card information. So this is the hacker sells your credit card number to someone, and someone uses that credit card number to go buy a bunch of merchandise and gasoline and all those things. You personally are not liable. Someone's got to pay. So Target has a liability. Do they have a liability for that? Would they accrue for that, disclose that, or do nothing? So the question isn't whether they have a liability. They are responsible for this. But how are they going to treat it at the end of 2013? Are they going to accrue for it, which means put it on the financial statements, book it, or are they going to disclose it only, or do nothing? So the question is pushed out in Learning Catalytics. So to get your answer in for that one. Again, there's a question in Learning Catalytics. You want to make sure you get your answer in for the losses resulting from the fraudulent use of the credit card information. Is Target going to accrue, disclose, or do nothing in its 2013 financial statements. 10 seconds left on this one. And the answer for that one, for the potential losses from the fraudulent use, that's going to be disclosed because Target is absolutely responsible. It's their data breach. They have to cover those fraudulent uses, but they cannot reasonably estimate it. They don't know for sure it's going to happen. It's reasonably possible it will happen, but they also don't know how much it's going to be. So there's no way they can write an accrual for something they can't estimate it. But also, it's possible that no one would ever use the 70 million credit card numbers, but I believe they have already. But this is at December 31st. So then the third scenario, a liability for fines or other obligations. So the regulatory agencies can penalize Target. The FCC or the Federal Trade Commission can say, you didn't have proper controls in place, we're going to give you a penalty. So they can do that. So the question is, and it's out in Learning Catalytics now, do they have, are they going to accrue for that, disclose it, or do neither? Okay, so there are these possible fines. You have about 5 seconds to get your answer in. But for these possible fines, what Target's going to do, they are going to have to disclose. Okay, they don't know what any possible fines could be, but more importantly, they're not totally convinced they're going to get a fine, so it's not probable. Yes, it's reasonably possible. Sure, it seems like, yeah, they could get a fine. Is it probable? I don't know, we could debate that, but even more importantly is, can you estimate the amount of the fine? No, this is unprecedented. So in this case, Target will disclose. So if you read their 10-K for the end of 2013, it's very interesting when they talk about that data breach and what they had to do on their side. And it did hit their financial statements in 2013, and it's going to continue to hit the financial statements in 2014 because a lot of these contingent liabilities are happening. So they're not. So the reason we disclose them is so that investors have the information. They have all the information to make an informed decision. But we can't accrue if we don't know an amount. So that brings us, that brings us to the end of today. So Wednesday we're going to do the long-term liabilities.